Hello and welcome to Smaulgld. In case you missed it, top gold and silver stories for the week ended September 3rd, 2016. Swiss National Bank increases equity holdings. Central bank market intervention continues as Fed launches another rate hike yak attack. Top stories of the week reveal more revelations regarding Hillary Clinton's email woes. There was a story that some of her aides had smashed a couple of her portable devices with a hammer. Won't comment on that any further. Top economic story of the week was the non-farm payroll number that came out on Friday, which was a big miss. We'll get into that and the market reaction as well. Gold closed last week at $1,324.80, pretty much unchanged, and silver closed last week up 4.1% at $19.42. Both precious metals were Warren Buffetted around as the Fed played, or markets continued to try to interpret what's going on with rate hikes as if it really matters whether the Fed raises rates a quarter point in the grand scheme of things for the price of gold and silver. But it highlights what we've been talking about, how the Fed manages to stay relevant, manages to keep markets and market participants trained on what it says, not what it does. The gold silver ratio closed at 68.22. It had been as high as almost 72 earlier in the week, but silver had a big rally on Friday, and as you can see, drove the gold silver ratio down. Charts of the week. COMEX eligible silver has reached an all-time high. Now that's the silver that's in the form that's eligible to be traded on COMEX. It's not the registered silver, but the eligible silver that's in the COMEX warehouses is at an all-time high. It's about 134 million ounces. But half of that silver is in the JP Morgan Chase depository of about 70 million ounces. Just important to note that half of the silver eligible to be traded, more than half, is in the JP Morgan Chase depository. There's about 5 or 6 other eligible depositories from Brinks and Scotia Makata, but JP Morgan seems to have the lion's share, and they only started that depository back at 2011, and it's pretty much stacked to the rafters there at 70 million ounces. Okay, let's go through the stories that we wrote, followed, or commented on during the week. Deutsche Bank, our friends have said that they see $1,700 gold. You can click on that link and see why they think that. Indian gold demand is the festival season is coming up, and there's been a strong monsoon season, so there should be a good crop this year for the rural farmers. And remember, the rural farmers buy their gold basically on their disposable income. If they've made money from their crops, they have extra money to buy for gold and during the festival season. So it looks like there was a very good rainy season, and that should impact the demand for gold as we move into September, October, and November. Platinum, there was a story about whether there's a deficit in platinum coming. You want to learn more about platinum, we've got a full report on platinum supply and demand, and a link here where you can check the platinum versus gold prices on a daily live basis, but also on a historic basis. And one of the things about platinum is, since 2005, gold has traded above the price of platinum, which is an anomaly for it to trade above platinum, especially for so long. But keep in mind that platinum is 10 times more rare than gold, and despite that, gold is trading higher. So that ties into the same theory about silver and the silver to gold ratio, that there is no such thing as a natural ratio based on rarity. You have to also factor in demand, and it looks like gold is in greater demand right now than platinum, despite the fact that platinum is indeed rarer. U.S. economic data, nothing really here to see that's good. Dallas Fed down 6.2. The employment index was down. Personal income was up, but then spending was flat based on the expectations. But of course, Reuters comes in. I just want to quickly read to you because Reuters always has a nice cheerleading analysis or comment to make on whatever economic data comes out. Strong demand for automobiles, pointing to a pickup in economic growth that could pave the way for the Federal Reserve to raise rates this year. No one believes that, but the Federal Reserve wants people to believe that, so Reuters is more than happy to oblige with these types of statements. Consumer spending is being driven by a tightening labor market, which is steadily lifting wages. That's not true either. Rising home values and stock prices, which are boosting household wealth, are also supporting consumption. Yes, among those who perhaps own homes and stocks, the wealthier, but the consumption, in any event, no further comment on Reuters. Dollar rises to 3-week highs on rate expectations. So you see, all these Fed yak attacks have the impact of boosting the dollar index. As we've been saying, the Fed doesn't have to do anything. They just have to talk about doing something, and still the markets react the way the Fed wants them to. The dollar has been boosted to 3-week highs, not because of positive economic data that would indicate they should raise rates, but just because the Fed says they think the data is positive and they should raise rates. De-dollarization, we usually have something on that each week. Iran and Russia are in a $1 billion oil field building deal where they will use local currencies, not the dollar. Another interesting story, Germans lose faith in banks, stash cash at home. U.S. Mint sales update, we won't go through this, but we will mention the final August American Silver Eagle and American Gold Eagle figures later in the podcast. Now, the Canadian Mint reports on a delayed basis, so they finally reported last week their full half-year sales. And what we've done here is we've put together a blog post. You can see, click on the link, but here's the chart that shows, at least through the first half of the year, the three sovereign mints, Perth, American, and Canadian Mint, had a dramatic increase in silver sales, 31% over last year's first half. But that was over last year's first half, which was a record year. So the first half of this year was a record year as well, and it smashed the record by 31%. Interesting story about a company, I think it's a gold mining company in Australia. They're going to pay their dividends in gold. Central banks cut their purchases of gold by 40% in the second quarter. This should be nothing new to Smaulgld subscribers. I've been reporting on the two largest central banks that actually buy gold, China and Russia. They buy about 82% of what the central banks buy. Their gold buying has slowed in the second quarter, also slowed in the first quarter. They're still buying, but they're buying at a slower rate. Economic data, consumer confidence was up, for whatever that means. Home prices have slowed and actually finally went down in the most recent Case-Shiller reading. If you want to be amused or annoyed, you can read what Fed Vice Chair Fisher says about how negative interest rates actually work, meaning not functionally, but that they work in terms of bringing about a desired impact. Now, one of the things here, this is the heading of the blog post, is Reuters notes that the Swiss National Bank is increasing its shareholdings, their equity shareholdings. And this, to me, shows that central banks gain more control after each collapse rather than lose control. Because the more control they exert over markets, the more they become the market and the more they can almost dictate where the market goes. Similarly, the Fed is masters at making themselves the center of attention in the short term, but they do that over a long period of time, so they keep the focus on where they want the dollar to be, how they want markets to react, just by yakking. And again, for those calling for collapse, rig systems don't collapse. Their operators don't lose control unless they're removed from running the rig system. So you don't beat the casino at the casino. The only way the casino loses is if the casino burns down or goes out of business. But if they're rigging the system, they don't lose control of that. They just rig it more. But here's what Reuters is reporting. The Swiss National Bank has increased its stake in all of its top 10 U.S. holdings this year, while many big institutional investors have been reducing much of theirs. Let that sink in. Institutional investors are leaving the stock market, but the stock market is going higher. Simple supply and demand. Why? Because of intervention. If central banks can buy shares, they can help boost the price of shares, just like the Bank of Japan does, even though the markets are saying we're buying fewer shares. Doesn't matter. The central banks will make up the slack. Around 20% of Swiss National Bank's foreign currency reserves are now in equities. Foreign currency reserves are in equities. Foreign currency reserves are in equities. Up from 17% last year and 10% in 2010. So basically, they turned the whole idea of what a reserve is, and a reserve now are LinkedIn shares, Tesla shares, companies that pay no dividends, companies that have no profits, just pieces of paper with a company's name on it that may or may not have any real tangible value. There's a graphic here you can click on it. You can see that the Swiss National Bank is the world's 8th largest investor. 8th largest investor, a little tiny country who could just print money up and become the 8th largest investor. For those of you who follow Rudy Haverstein, it's an enjoyable endeavor on Twitter. He mentions, I can imagine a future where central banks buy entire companies, pick board of directors who will do as they're told, issue debt, central banks buy. And that basically is a dystopian future, but we're on our way there because right now the Swiss National Bank is the 8th largest shareholder in the world. Why can't it become the first? Oh, I know why it can't become the first. Maybe the ECB becomes the first, or maybe the Bank of England, or maybe the Fed. There's really nothing stopping these banks from increasing their equity positions or buying more bonds or buying whatever they want and printing up the currency to do it. October 31st, we put out a blog post and a YouTube video on 7 ways to get higher inflation. Quickly, it covers the Fed's inane desire to create inflation because they think that somehow creates economic growth. And if they really want inflation, we give them 7 ways how they can get it. Top 3 sovereign mint gold sales were up 49% in the first half of 2016. You can see the chart here, Perth Mint, Canadian Mint, US Mint, all showing a nice increase in the first half of the year in gold sales. You can check out all the details on that at the link. Gold. Now, someone dumped $5 billion in notional gold amount. Again, another one of these drive-bys where someone sells short a bunch of gold for no reason, just does it, and there it is. You can see went from 1314 all the way down to 1306. That was on the, I think it was the 31st. When was that? That was, no, that was the 30th. Okay. Scrolling on down here. Let's get the scroller working. Interesting. So popcorn drenched in gold. I have a blog post. I think it's called Gold for Smoking and Munching, and I catalog all of the different ways that have been reported where people are actually eating gold or smoking gold. I added that popcorn one to that blog post. Now, Chicago Fed President Evans says low growth means low interest rates here to stay. All right. So that should just settle it then. We're not going to raise rates. But no, he doesn't really mean that. He means low rates in general. That doesn't mean that he doesn't think that rates are going to go higher later this year. Chicago PMI down. Inventories down. ADP, this is a precursor to the non-farms payroll on Friday. 177 down from 194 in the last one. U.S. Mint sales we'll cover as we get to them. Now, American Silver Eagles for August were down again after being down in July and down in June. So you definitely can see the drop off in American Silver Eagle sales. You click on that, you can go through the reasons. There's a blog. There's also a companion YouTube on the YouTube channel about the reasons potentially for the decrease in silver. One of the reasons I think is there is now a shift towards gold. As we head into the fall, collapse potential, October, it's always on everyone's mind. People move into gold, I think, more than they move into silver, especially the larger investors. And we see moving into the fall, August numbers for gold were up sharply whereas the silver numbers were down. Yes, part of that has to do with front end loading the sales earlier in the year, but there was an increase, a pickup in the amount of gold sold in August, and I expect that to continue through September and October, whereas I don't expect the silver to rise that dramatically again unless there is an actual event, in which case I would expect both gold and silver physical demand would rise. But absent, if it's only psychological or people are anticipating something to go wrong, then I think gold gets the lion's share of the dollars, not necessarily the ounces, but of the dollars moving into gold. There was a story, I followed it all week. Many of you probably did. Deutsche Bank's Xterra Gold, which is a ETF, supposedly has a redemption feature where you can say, look, I want my gold. I've got X amount of dollars. Give me my gold. Someone asked for it and they told them, go pound sand. What does that mean? I don't know what it means. It means Deutsche Bank didn't give them the gold. Does it mean there's a shortage? Probably not. I mean, you can still buy gold in many places. It's not hard to get. There's not high premiums on it. In fact, in India, there's still discounts on gold. So I think it more reflects Deutsche Bank's practices. And I just think it doesn't reflect well on Deutsche Bank. But then a lot of things haven't reflected well on Deutsche Bank at all. U.S. economic data, initial jobless claims were low, but they're always low. But, of course, Reuters says it points to sustained labor market strength. Again, that could push the Federal Reserve to closer to raising rates. Closer, not that they will raise rates. And, of course, this is associated with a robust labor market. You know, I always say they like to, and I see it all the time, robust, solid, strengthening, sustained. Those are the words they use to describe the labor market. August manufacturing, so much for robust and solid. ISM new orders 49.1 indicating a contraction. ISM manufacturing in August 49.4 also indicating a contraction. Reuters, no way to sugarcoat this, calls it shocking contraction. You know, contrast it to their solid and robust strengthening of everything else. There it is, Reuters, shocking contraction. This is their words here. Shocking contraction in August manufacturing activity. Push back some market expectations that the market could hike rates. So it's only some. Everything, all the other times when they mention it's economists believe they're gonna raise rates. Okay. Another Fed yak attack. I think this is Cleveland Fed Meiser. The case for a rate hike is compelling. Well, of course it is, and it's been compelling for years if you believe in sound monetary policy. But they haven't raised rates, so how compelling can it be? Okay, we're going to skip over the U.S. Mint sales. And there's a follow-up here. There's a few follow-ups on this Deutsche Bank story. I'm not going to go through them all, but you can follow, or you can Google them. But I've got the links here in the blog post that you can access at the bottom of the YouTube video. You can click on it. You can review all these stories. I don't cover them all in detail. Indian gold, festive buying spurs Asian gold demand. Indian discounts narrow. Gold recovers on global cues. Jewelers buying. That's again in India. So it looks like Indians have pent-up demand. They did not buy as much this year as they did last year. They did not import as much this year as last year. But the monsoon season was good. And since they didn't buy this year and prices have stabilized, many are expecting, not all, that